Let's center this around an article from the Wall Street Journal today, where they reported that companies selling everyday goods say lower income consumers are struggling, but better off households are spending freely. Adam, we talked about this on our last podcast. What does this mean for investors?
Look, I think it's another interesting data point where the sort of the rich are fine and the lower and lower middle class are starting to struggle. And as that dynamic continues to evolve and to grow, that's something that could sort of pull the economy apart. And with the article talking about people having to trade down, it cites toilet paper, and man, I feel for you if you got to go down to single ply.
Austin, what are your thoughts?
I think that there's obviously the article that Adam's referencing talking about how the lower end brands, whether that be toilet paper or razors, are benefiting from trade downs, but we're also seeing many of the, let's say, lower tier restaurant operators coming out with value meals. So you're talking about the $5 meals with McDonald's and Burger King. And I think it says more about the price increases that a lot of these companies forced through 2 or 3 years ago when inflation was high than it says about where we are today. And there's likely a price adjustment that needs to be made. They're going the shortcut and using, deals and coupons to try to reduce average pricing. But consumers are a little upset. Like they don't like paying, $10 for a Happy Meal at McDonald's, or paying, a significant amount of whatever their take home pay is to buy basic goods, whether that be cereal or toilet paper. And so I think as we look out from a impact on equities and markets, these companies that were historically more predictable in down markets are actually struggling right now because they pushed through so much pricing 2 years ago. If you looked at top line growth, most of it was, they'd be up 5 to 7% on pricing. Volumes would be down 3 to 4%. And then they'd see a nice low to mid single digit revenue growth number, and they'd see margin expansion, and investors were really happy and they paid premiums for that. Well, going forward, as the pricing comes back down, if they can't get volumes to support that, they're going to see volume declines for the first time in a very long time. And we're not going to be able to support the valuations we're seeing in some of these more stable companies. So I think investors need to be cautious on how they think about protection in a down market. And it might not be the historical buy consumer staples or buy fast food restaurants when times are tough, because everyone's going to be trading down. It does seem that the people who are at the lower end of the economy are trading away and not trading down. And the people at the higher end of the economy are not trading down because they don't need to. So it's leaving a gap in many of these more value-oriented spaces.
Yeah, like if you go back sort of 4 years and you think, we had sort of a generational high government stimulus due to the pandemic, followed by generationally high inflation, followed by generationally high price increases to counter the inflation. And where are we now? All that's happened, and where do we sit now? And an interesting chart in that article talks about adults who could cover a $400 emergency cost in cash. And you go back to from 2013 to 2021, that went up from 50% of adults to almost 2/3 of adults, or over 2/3 of adults. And in the last year or so, it's started to come back down. And that sort of, it doesn't suggest we're at a crisis level yet. But if this trend continues, at some point, the economy will crack.
It's a sign that the government stimulus and the yellow profits have actually finally started to fade away.
Right.
And so we're seeing a more normalized economy, which is going to provide some unique outcomes from a corporate earnings perspective. And it'll be really interesting to see how that kind of plays out going forward. And, tying something that we talked about earlier, what happens if your electricity bill is up 50% and, you're not able to buy as many, Lucky Charms at the grocery store because prices are also up 20 or 30%. So it could create a unique dynamic, and heading into a presidential election, who knows how that's going to play out.
Yeah, and these consumer staples companies that went from several years of price increases some of them are now back to pre-COVID couponing and discounting. So we've come full circle. And
Yeah.
at some point, this will impact sort of aggregate growth, GDP.